Where do you think there are specific pockets of risks that we all need to pay attention to in the year ahead?
Well, banks have shown to be pretty resilient so far. They have a strong capital position, strong liquidity position, big recovery in profitability, for the first time a double-digit return on equity. But if you look at the outlook for risks, of course, we need to keep remain very alert. Credit risk is still an area of concern, especially real estate, commercial real estate, so the segments which are more sensitive to interest rate. Leverage finance, counterparty credit risk are the area of attention for us, and then funding and interest rate risk in the banking book. Funding risk and interest rate risk in the banking book, driven by the rapid changes in the interest rate environment.
One big focus on this side of the Atlantic, Andrea, has been what's happening in private markets. I just wonder, on your side of the Atlantic, how you're gauging what's developing in private markets. How are you monitoring that?
Well, we are also monitoring the exposures of banks. Of course, counterparty credit risk is the main element. No, is the area where banks are taking positions vis-à-vis non-bank financial institutions, and this has been an increasing area of attention for us. We should clear expectations on the banks to step up their onboarding practices, their monitoring practices, and their risk management. So this is definitely something we are looking into very carefully. But you know, the key issue is that with non-bank financial institutions, sometimes there is a lot of opaqueness. So there is a broader question whether maybe the perimeter of regulation should be expanded.
Do you get the sense that there's another Credit Suisse out there? And I say this with respect to another bank that could be forced to either merge or dissolve in short order in response to a sudden event.
Well, looking at European banks, I think they've shown remarkable resilience. If I look at the events of the spring of this year, the turmoil in the spring, I think the two things that made European banks stronger are the fact that the unrealized losses are relatively contained compared to, for instance, banks in the US. And the other fact is that they have a very well diversified deposit base. Still, this should not lead to complacency, as I said, because indeed we see that when there are these moments of turmoil, markets start to look at banks not anymore with their traditional balance sheet key indicators. They look at market value, at economic value of equity, and at the sustainability of business model. So these are the areas where we want banks to focus their risk management and to focus the improvement of business model sustainability. We think is key to be safer from these type of events.
Would you like to see more consolidation, particularly as you do look for capital raises to insulate against the next cycle?
Well, we have said from day one, since I joined in 2019, that we were open to see more consolidation. There was an issue of excess capacity still in the European banking sector, and consolidation could have been a good element to address that. And the other point is that having more cross-border consolidation, of course, would improve the private risk sharing, the ability to withstand risks in one country with profits, losses in one country with profits in another one. So we have seen some consolidation within borders, within domestic borders. We're seeing some positive acquisition of business lines which have helped banks to refocus their business model. We have not been seeing cross-border consolidation. So our market remains segmented along national lines. In the long term, this is not good news. I think that this makes the market more fragile.
How does that change? What do you think sparks that change?
You know, of course, the easy answer is the completion of the banking union. So having a common deposit guarantee scheme that would create a common safety net and therefore would remove an important obstacle to cross-border consolidation. Still, I think this is not going to come for a while, because we know that there has been a very fractious debate in the European Council. Member states have crossing red lines, so this is not going to happen any soon. I think the banks should take ownership of this objective, they should themselves invest into more integration in the European markets. We offer them some options. For instance, we have seen the banks relocating after Brexit. They've opened branches. They've transformed their subsidiaries into branches, and they are now operating in the single market without any local capital or liquidity requirements. We suggested that European banks can do the same. So far, we have not seen move in that direction, but that could be an interesting model to try to integrate more the market.
We've been talking about this for years. In fact, the conversation over the last decade has just been how much stronger the US banking system has been, how resilient the US banking system is. And then March happened. You touched on March. Andrea, I just wonder, as a European regulator, what the lesson from March actually was to see the failures take place in the United States and very limited failures take place over in Europe. Why do you think that was?
Well, there are different reflections that can be done. First of all, it's clear that in the US there was a more bifurcated regulatory framework, in which large, globally systemic important banks are responding in all senses to the international standards, while smaller regional banks are not subject to that. So a positive for European banks is that we apply the international standards across the board to all the banks, irrespective of their size. Another point is that, which is important, I think, is having more attention to economic value of equity. Not only, I mean, the increase in interest rates has been a positive for banks across the board, especially in Europe, where profitability was depressed for a long while. But of course, it can raise issues if you have large unrealized losses. And European banks were a bit better off in that respect. But still, we have seen very massive outflows of deposits. So I think that funding and liquidity risk should be very much in the radar screen of supervisors going forward.
Well, given everything you've just said,
what we are doing right now.
Just to wrap things up, pockets of risk, but still resilient, better performance given what we've seen take place in America earlier this year. The level of dividends, share buybacks that we saw this year, do you see reason for that level to be maintained next year?
Of course, that's not for me to decide. That's for banks and banks boards to decide. But yes, I think that banks have been particularly profitable. They are planning distributions which are in line with previous years. The last figure I saw, tentative, of course, and very preliminary, is around 70 billion of dividend and buybacks for 2023. Again, what we do is to check that these dividends and buybacks are compatible with the trajectories of capital for the banks, and if so, we have no objections to that.